Okay, folks, let's get started. I hope you're all well. Thank you very much, FX Street, for allowing me the opportunity to share some information with the foreign exchange trading public. It's always a pleasure to share information with the group. I want to say that the information that I try to share in these sessions is really information that I really wish that I had when I was in the earlier stages of my development. And so I just want to try to help to accelerate your development as traders. And for those of you who are more mature traders, which I'm sure we have a good number of them, I hope that maybe you can gain something in the information as well. Okay, so let's get started. I'm really going to focus just on one really specific area today, and that's going to be the process of development for trading success, and talk about some of the challenges as you navigate the process. So I'm going to bring up a slide that's going to effectively show you the model that I've used to develop and the model that I recommend to others to use. So it should pretty well lay out a pretty good framework for you. So first of all, for those of you who are newer, my name is Chris Laurie. I'm registered CTA member NFA. I've been in funds management and foreign exchange for 10 plus years, 14 years in foreign exchange, and 6 years sharing information with the general public. Previous to my foreign exchange, call it a career, I competed in Olympic sport, and I was in 4 Olympic Games, and we won a number of medals and whatnot. So you can get that online. So the ultimate question is, the reason why I wanted to raise this question today is because I get a good number of emails of people just basically laying it out saying, what do I need to be successful, and what do I need to do to be successful in trading? So I just put together on one slide really the framework of the process, and it really is extremely important that you are process focused. So I only really got a couple slides for this presentation. We may run a bit short overall, but I think if you take a snapshot of this slide, it should give you a pretty good framework. Really, what I want to go over is the process, and it's pretty well laid out in this slide. Again, the common question is, what do I need to do to become successful in trading? And I want you to really take this very seriously, because it's going to involve some work. So when I refer to the process, I'm referring to really effectively what is laid out in this slide. So another common question that we get is that when one listens to a successful, presumably successful trader, or if one is trying to copy or learn from somebody else's model, or try to effectively copy specific parameters from somebody else's model, one often thinks that the professional trader is holding something back. And ultimately what they're holding back is something that quite simply cannot be shared, and is the internalization of details that are retained from market experience. So what do you mean by market experience? Is market experience just simply taking a trading, call it a system, putting it on my computer and sitting there and watching it for hours on end, waiting for my next trade? Well, it actually, what we do want to do is we want to go a lot deeper than that. And this is really ultimately what we want to lay out before us. So if you're pulling up your charts, pulling up your brokerage account, and you've got a set of parameters laid out that you have reasonably established that these parameters can establish a certain level of probability, it's very important that you have a pretty deep understanding of each of the parameters that you're using. And when I refer to parameters, I'm pretty well referring to everything that's laid out here, and I'm going to walk through it for us. So let's just look at the 3 kind of primary categories: the fundamentals, the technicals. In my case, I use price behavior, and of course the psychology. But let's break this down, because each are held separately, but they're also effectively commingled, or basically webbed together. So when we refer to the fundamentals, it's really quite important that even though you may call yourself a technical trader, or you rely 90% on technicals to guide your trading decisions, position management, your risk model, it's really quite important to understand the framework of the market from a fundamental perspective as well. And when we refer to fundamentals for foreign exchange, it's very important to have an understanding of monetary policy, and what they refer to these days, kind of the catchphrase is forward guidance, monetary policy positioning within the context of its own region or country, as well as how monetary policy is positioned in relation to other countries and other regions, and the shifts that are taking place, which typically is reflected in interest rate spreads. So monetary policy is more the broader framework from the fundamental perspective. And of course, the constituent parts of monetary policy are going to be the data events, as well as the policy statement. So when we break monetary policy down, it's going to be established, or the direction is going to be established, or the forward thinking of the market is going to be established through the stream of data that comes out. Now, if you're day trading, for example, it's important that you understand, even though your decision guiding parameters may be technical with whatever type of formula that you use, it's really important that you have a good sense for what, from a policy perspective, what the flavor of the month is, or the flavor of the cycle of where we are with the economy. It might be jobs, it might be housing, it might be broad-based growth, but to have an understanding of the data, because depending on where we are in the cycle, the data, of course, is going to drive price, which you're going to see technically, and you're going to need to make a decision on, in one capacity or another. So to understand data in depth in terms of what type of volatility it can potentially drive, getting an understanding for the market response to the data as it pertains to the broader fundamental perspective, even though your trading may be technically guided. So this is going to establish the overall environment of the market, which is going to generate a market response, because the market response may be in contradiction or in opposition to whatever the data suggests. And that's important to understand, because over time, if you establish parameters or a structured manner in which you're going to come to understand or build a tight acquaintance with the market, or tight connection with the market, you're going to obviously see that we see this repeated day after day, week after week, month after month, year after year, and you start to identify the patterns and the shifts in the market. And that's going to change the environment, which changes the market response. And when we talk about the market response, we're seeing that right now. For example, with volatility is very, very compressed. Volatility is very low right now. And so you may have a trading approach that you can adjust to the low volatility, or you may not. I know with the approach that I take for intraday trading with price behavior, we're able to very, very quickly and effectively adapt. Now, perhaps another question that I also get is I want to trade longer term positions because I don't have time to sit at my computer and take on intraday movements. Then that's going to weigh more heavily on fundamental factors, of course, because for my personal position trading model, I will look at the fundamental drivers, where we are positionally from a fundamental perspective in relation to the various crosses, but I'll manage it technically. Okay, but the fundamentals are really some of the main factors I'm looking at in terms of what's driving trend and FX flows. So we have the fundamentals, so it's important you establish a protocol to break this down, to very, very specifically study the volatility response of the market in relation to the level interest and connection of fundamentals in the market, what type of environment it's establishing, and the market response that it can generate. Now, what I'm going to do, I am going to talk a little bit, and in a moment I'm going to show you another slide that speaks more specifically of technical. So I'm going to give you an example of exactly what I'm referring to here. And once again, so let's say, for example, somebody gives you a fundamental trade call, and I'm referring back to this internalization of details retained from market experience. So if you hear of a trade recommendation to buy a certain currency or sell a currency based on someone's fundamental view, now their fundamental view is going to be established on a different set of parameters because they will have internalized details from market experience and market knowledge from quite a different perspective. And which is why you need to go through this process yourself in order to establish more accurate parameters. Okay, so, and that not only applies to the fundamentals, but the other areas as well. So very, very important to really go through. When you engage in the process, you will internalize behaviors to a level that cannot be taken away from you. So if you're just out trying to copy somebody else's model, then there are too many missing pieces. It's really just an empty vat, and you have very little information and reference points to draw to guide good prudent decisions throughout the process of selecting and managing trades. So by the nature of going through this process, even if you take only a fraction or use only a fraction of the information to guide decisions, it is going to be a very, very profound component of your trading decisions. Now, I realize that the technical element, so let's just kind of break away here now to the technical element as a separate component, yet it is connected to fundamentals, of course, and psychology, but let's just take it in isolation. So, and I'm going to refer to the protocol that I use, and I use price behavior. And the reason why I use price behavior, I don't use any mathematical models at all. I don't use indicators, and if I do have an indicator on my chart, I don't really even see it. But I use just simply the price behavior because it has over time substantiated itself to such a profound degree that I really don't think I need to go anywhere else. So what I do is I'll take a very specific price behavior, which I'll show you once I get through this slide. I take a very specific price behavior and I will analyze it, and I'll analyze it over time. So I will do a very, very large sample size of the specifics of that price behavior in order to either validate the behavior, and elements of validation can be the price behavior will be studied at different market times, different sessions, overlap of sessions, different times throughout the course of an hour. The price behavior in relation to the different data points, whether it's CPI, ISM, jobs, housing numbers, the behaviors in relation to the data and the environment. So after having engaged in so when I establish a set of parameters around a price behavior, it is a structured element that allows me to gain a deeper understanding of the price behavior. So it's not random. I've taken the time out to establish the parameters, which we'll show you in a moment. Now, these price behaviors, another important point is if I focus on a price behavior, it can either validate itself, it can be the conclusion can either validate itself, it can be neutral, or it can be a negative reinforcement or negative validation. So in other words, if I am engaged in a trading situation and I see a price behavior that I have gone through the process of either validating or invalidating, if it has been invalidated and I see a price behavior, then that is going to influence my decision in terms of whether or not I want to take the trade or whether I want to bail out on a trade that has been taken. When I see invalidated price behaviors, It can certainly weigh my discretion to decide of wanting to maybe bail out on the trade. So going through the process of establishing parameters to validate price behaviors, when you do sample sizes of 50, 100, 200, 500, and then over the years, 1,000 or in the thousands, you are going to be very, very specific and detailed in your protocol of your trading model on how to manage that trade. Okay, so this becomes this deeply internalized detail of retained market experience. And the reason why it is retained is because you have a set of parameters. If you're just sitting at your computer randomly looking at charts and grabbing, if you're a system junkie and you grab one person's system and another person's system, and then a new tool you put up on your computer, and then another new tool, then you get rid of an old tool. Unless you've gone through a structured process of validating the tool, then you're more or less taking a bit of a random approach. And that's not going to be productive and conclusive. So you validate the price behaviors. Then, of course, there are volatility drivers which are going to come from this element over here. So the deeper you understand this, even though it doesn't too heavily weigh on your decisions, perhaps, it's important to understand the volatility driver, because when we have price moving to certain levels where we're looking to make trades, we will weigh into the decision what was it that was driving price. And sometimes, a lot of times, it just doesn't matter what's driving price. Okay, it really doesn't. So we don't get caught up in that. But what we find, for example, as an example, we find that when information comes out that is very, very tightly connected to monetary policy, like a central bank speak, and it creates a diversion in where the market is currently at and what the market is repricing in, so that they surprise the market with the information. Well, we find that volatility driver is very, very dangerous to stand in front of, and you want to stay out of the way. So that's just one example of how we connect these two. And so then that's going to create a market response. So it all comes together into a market response. What's important here is that as you go through this process and this process, you are again internalizing the behavior, so that eventually you will go through the process to such a deep level and you'll enjoy it, because you'll actually start to see substance come into your trading. And once the information of the foreign exchange flows, however it is you're viewing the market, once it becomes internalized, no one can take that away from you. What you're doing to yourself is you're building a very, very strong trading persona, a very strong trading mindset with a solid foundation. And that is something that can never be taken away from you. And then that will give you the foundation to adapt to the market changes, to make prudent changes to your trading model, your risk model, as volatility in the market changes. So let's go over to the psychology. Now, the psychology is obviously connected to the fundamentals and the technicals. As in the psychology, as you develop your trading persona and your trading mindset, can either be productive or destructive. Now, what I find is that people who are going out and just randomly trading, or randomly grabbing somebody's system and trying it out, or randomly grabbing somebody else's tool and trying it out, then and if it's not productive, that can actually weigh negatively on your psychology. So the more structured your approach on building this entire framework by committing to a structured development plan, then your psychology will develop in a very positive, progressive manner. And so not only does your psychology develop, your model will develop concurrently, and your model will also have a very solid development as well. So the challenges that are met and engaged upon and met through this process are going to develop your psychology in a positive way, as well as your trading model. And of course, when I refer to trading model, I'm also referring to your risk model. And as a result, you will experience psychological maturity. So you understand yourself at a deeper level, and as you are progressing with your model development. So, and those of you who are more mature traders, perhaps this information can give you a framework to just simply refine a couple of things in your trading, or act as a reminder, or even a reflective of what you've already experienced, and it'll just allow you to piece it together. So ultimately, where we're going here is we're going from, we want to remain process focused. And when I refer to process focused, I am not saying that you go in front of your computer every day and you have to make a certain number of pips, or you're just thinking about the money, because you do not want to think about the end result. When I was in my Olympic sport career, of course, there were certain results or numbers that were the end product, but the focus was entirely on the specifics and the details of the process, every minute detail that you could possibly imagine. And I felt that as a competitor, your edge is your own unique persona and your understanding of yourself. That is your ultimate edge. And your edge in trading is going to be by engaging in a proper process and psychological development to ultimately become the independent thinker that you are all capable of. And that's when you will succeed in the marketplace. And what I find, what I found with my own experiences, both in sports, other areas in life, and in trading, was that when I used more of a filter when listening to other people and relied more heavily on my own independent thought based on the experiences that I had accumulated over time, that is ultimately going to be your breakthrough time. Right here is because it's not going to be like one day you're just going to bang be an independent thinker. It is progressive over time as you engage in the process. The independent thinker emerges and ultimately comes to fruition, and the time at which your independent thinking breaches certain thresholds, that's when you will become successful or be successful or realize success in your trading. But it is only going to be a result of a structured formula and a process and the means to get to this level. Now, along the way, we're going to make all kinds of mistakes, and we're going to go in directions that we should not go. But what's important is that you realize that sooner than later. So that's just a natural part of the growth process. So as you go through the process, you increase your ability to refine what you're going to focus on, resolve any issues, and internalize market elements in a much more efficient manner. And ultimately, the destination is independent thinking. So where I'm going to go now is we're going to flip through a couple slides, and we're going to just talk about, just give an example of what I mean about structuring a process and just from a technical price behavior perspective. So I just threw a couple of other side notes in here. Refrain from attempting to copy trading strategies. Now, you can copy a process and very specific elements of the market, which when I train people, and you may have seen some of my previous webinars, we talk about certain specifics of the market, which will help to accelerate your learning and also give more guidance on structure. So you can copy that type of thing, but you can't copy a strategy. If you're going to copy anything, copy the process of developing a trading model. So when you've engaged in the structured process, your knowledge of the market, your model, and yourself become irreversibly deep. And this is what sustains you as a trader. You will not be sustained as a trader if you're running around going in one direction and then another direction, or just sitting in front of your computer all day waiting for a trade to set up. Because while you're sitting at your computer, you can use your time very, very productively, even in the live market. Doesn't have to be a backtesting protocol. a live market protocol, you can be very, very active in the market, learning through a structured process and internalizing the information. So let's just talk here about the technical price behavior element, and then that'll be it. So this is a sample breakdown. You may have seen this slide before. If I'm taking price action, I can break price action down into different categories, and there's more categories in this, but that's all I can fit in the slide. And then you break down, let's say, for example, time of day. You've got the different times of day, and what price behavior does at those certain times of day, what patterns emerge. Now, naturally, when you break down the different elements, they are all going to be sort of interconnected, if you will, to some degree or another. And so if you isolate each one of these and study them in isolation, obviously we're going to see the interconnectedness of the different components, but you'll also see how some are more profound than others. And so then you plan a protocol, you test it, you validate it, and then you internalize it, and you eventually integrate it into a model. So while you're in that process, you're going to refine your risk parameters as well. Okay, so as you put price action through the grind, you'll internalize volatility as it relates to various drivers over large sample sizes. So a sample size is also an interaction in the market. So an interaction that's based on a set of parameters. So you can accurately build risk parameters to suit the trade setups in your evolving plan. So let's just, I couldn't pull the charts up because I was getting some conflict with the programs here. So I just took an old chart. And let's just say, for example, this is the 45-minute euro-dollar chart. And let's just take just support and resistance, okay? You go to your computer, you pull a chart up, and you lay out some parameters. We'll say just support and resistance levels. And let's say we're going to isolate a few parameters. Support and resistance. I look at the anatomy of the move and the price driver. So for example, when you have a price move, let's say, I don't know, from, let's just take from here down as the leg comes back into create a price swing, we have what's called the anatomy of a price swing. So let's just take support and resistance. Now this is a 45-minute chart. If you were to take this down to a 5-minute chart and you were to have an interaction at each level of support and resistance based on a set of parameters, maybe a 10 pip stop, 10 pip limit, or 15 and 15, and watch the price behavior. Now there's, we watch the order flow as it moves into these different levels, but you can see here prices drop back, it comes back, you see a shift in the order flow, and then price continues to fall. It comes down to, so what I'm looking at is I'm looking at the anatomy of the move. So I'm looking at the anatomy of the movement down into the next level of support. I'm looking at the anatomy of the up move. Price comes down, it responds to this area of order flow here, this fractal, and price comes back up to this area of order flow here, then it drops. So, but I'm looking at the anatomy here, the anatomy here. So as you go through the course of a day, and then price comes down to the next, not quite the support, comes back up to the resistance, comes back down, nice anatomy on the move, goes into the inefficient leg, goes back to the last area of order flow, it responds, comes back up, hits this resistance. So if every time price did this, let's say you pull up a 5 or 10 minute chart, 7-minute chart, doesn't matter. If every time price moved to a level of support or resistance based on whatever time frame you designate, you interacted with price, you are now going to build a profound connection with price volatility at certain areas of order flow or of support and resistance, or psychological levels, call them. And this is just one small example. Now, the support resistance can obviously expand into and have other contributing factors like what session it is it in, or time of day, data points, things like that. So as you integrate each of these elements, you're going to gain a deeper and deeper and deeper understanding of price volatility at specific points and time in the marketplace. And that is going to help you to connect with the market at a deeper level. And this is just one example of one of sort of one element called support and resistance while considering the anatomy of the move and the price drive. So um, if you've got a protocol like this, and if you sit in front of your computer and watch a couple of different currency crosses, you can literally have 5 or 10 interactions in a day. So what's more productive, sitting at your computer, waiting for a trade to set up, or consistently interacting with market volatility throughout the day based on a specific framework and protocol, which will help you to gain a deeper understanding of the market under a list or a set of parameters. You're obviously going to be highly productive doing the latter. So if you can think of like a month or 2 or 3 months or 6 months or a year of time that you found that you have made no progress, imagine if you had invested that time in a structured protocol. Okay, so good question. Why do you like the 45-minute chart? When you are trading price behavior, it doesn't matter if it's a 7.5-minute chart, a 15-minute chart, 16 minutes, 17 minutes, 23 minutes. A chart is a chart is a chart. It doesn't matter. The industry has become aligned into thinking because the producers of data, a lot of them only have options for, let's say, 1, 5, 15-minute, 30-minute, hour. The market has become accustomed to defaulting to these time frames. But when you become, when you engage deeper in the market, you'll realize that you know, you kind of fall into a box in that element. So really, to me, it really doesn't matter. I just pull up whatever chart gives me the best visual of what it is that I'm specifically looking at or looking for or looking to study. Okay, so in this case, a 45-minute chart just gave a nice, nice image. And so during consolidated periods, I'll pull up different time frames to give me my parameters. Yeah, there's a blue line here on my chart. It's really virtually meaningless. It looks nice. It carries no weight in my trading decisions. But pretty well every time if I do a webinar and I've got this blue line on here, and people ask what it is, but it's just, in fact, I don't even know what the number is. So, all right. So I just wanted to, sorry, I've forgotten this one. I really wanted to just show you this chart because sometimes I do webinars and I just blast information at you, and it's a lot to take in. So really, if you take in this chart and if you sit down and draw out a process in order to engage in this flow, then I assure you, you'll develop more substantially in a shorter period of time. And this you can take whatever time your schedule allows. The nice thing about this kind of protocol is that when you are at your computer or when you're going to sit down and take on a session, you'll be more specific in your directive as you take in the information. So one of the most dangerous things in foreign exchange in trading is you don't know what you don't know. What you don't know is harmful to you. What you don't know is profitable to you. It's also harmful to you. So you need to be very, very, very careful. People come into this marketplace with very little knowledge, and they're very vulnerable to what they're not aware of and what they don't see. And so I see a lot of that. But so hopefully this framework, the nice thing about, I know the title of this webinar didn't do it any justice, and the kind folks at FX Street said, maybe you want a more catchy title. And I'm like, I don't know what to title it, because I actually didn't know that I was going to draw this out. So it challenged me nicely, and so it worked out. So maybe when we archive it, we'll put it under a different title. But anyway, that's pretty well, what I wanted to lay out for. If you guys have any questions. I apologize for the technical glitch. I was just seeing there's some interference on my machine. I don't know why, but Any questions on this? I know that a lot of people like to come to webinars and they want to hear about trading systems, and they want to know when to get in. It's important that you engage in the process. So a question here is, do you mean back testing? You can obviously develop doing back testing. There's a lot of different types of back testing you can do. If you're going to back test, I think you need to have an economic calendar running alongside of it, because that will skew the data, or it'll help you to understand the data a lot more. So so the question is do you back test? Well, I mean, I spent so many years back testing that at this point I am so concrete in my approach that every single day that I sit in front of my computer, my parameters are so tight now that I can adjust to the market volatility and change the market volatility, because when you're trading price behavior, you're most connected to the psychology of the market, and you can pick up on the changes in volatility literally hour by hour, day by day, week by week. You can pick it up very quickly. So unless there's something that catches my eye that may be a new area of exploration, I don't do a lot of back testing these days, although if the situation calls for it, yes, I would. But I feel that I'm pretty concrete in my approach after all these years. Things are pretty clean. So, hey, Don, how are you? Nice to see you. Yeah, Don, we've moved a long way from that point. We've gotten a lot more specific as well. So if you view some of the webinars at chrislaurie.com, it'll give you an idea. There's free area. It gives you an idea as to some of the more details. Because as I sat on my computer, I started thinking about very specific details of price behavior, and I'm like, why don't I just create a module on that price behavior so people can go out and study it and put it in their own protocol, to determine and to try to validate it for themselves. All right, so we've gotten a lot deeper from that point. Michael, how are you? Once you know what you didn't understand over time, you appreciate the importance of building the model. This is Michael Olson's professional trader. More so when you don't do it and waste time and possibly money by not doing it. So, correct. So it's amazing because, for example, have you ever, been trading and then 1 year down the road, you'll look back and you'll say to yourself, I can't believe I was trading live a year ago, based on how much more I know now versus how little I knew back then. Very, very. Have you heard of 10,000 hours? No, I haven't. But if it makes reference to 10,000 hours, it's probably pretty solid. The general approach, Ray, the general approach that I take, it's a price behavior approach. So I study the anatomy of the move that I'm about to trade into. I study the anatomy of the overall framework of the chart. I consider the data point, so it's surely price behavior. So the execution model will change based on the volatility. So where the stop will open up, because I use an average gain to loss ratio for the outcome, and so the initial bracket for the trade will be adjusted according to the change in volatility based on the type of trade that I'm taking as well as the environment at the time. Okay, but for longer term positions, it's a lot of it is policy centered, but the trading is done from a technical perspective primarily. Okay, so yeah, good question. Are fundamentals a driver in your trading? Well, it's really critical that I understand the fundamentals because, for example, I'll understand where things stand from an interest rate spread and FX flows standpoint, policy. And for example, if we have a really positive data point in favor of a currency and the market doesn't respond, or it responds positively or consistent with the data point and then rejects, then I want to be in the direction of the rejection. So it simply means that there are outweighing factors that are preventing the currency to flow in that direction. So I'm going to try and get in a move in the opposite direction. So that's how fundamentals can help you a little bit by connecting with the market. Also, an important part of the trading is what the market's responding to at the time. So whether it's equities markets, whether it's rate spreads, they're focused on an upcoming statement. So I watch the technicals in relation to where we are from a fundamental perspective. What is percentage? What percentage are you? I'm not totally clear on the question. Boyke, you've been around for a number of the webinars, so thanks for coming out. What percentage risk? Is that what it is? I use average loss to gain ratio based on the volatility. So you summarize the trades, how many were break even, how many were loss, how many were percentage loss, what was the loss, what was the percentage, and what was the gain, what was the percentage, and how does that ratio weigh out over time? Hey, Lauren, how are you? What would you by any chance by having another workshop in Singapore? Yes, in the fall we're in Singapore. I have put in practice what I took from the last workshop, and it's turned my trading around. The manual is fantastic. Thank you very much, Lauren. It was great having you guys in class. Very sharp students. So glad to hear I know you're the type of student that will take on protocol. Yeah, Florida, we'll do a workshop, I think, in the summertime. Yeah, Robert. Yeah, I think 10,000 is just simply like a number to exemplify the point that one needs to invest a certain amount of time. What's going to happen is that the more scattered you are in your approach, the more hours you're going to spend in front of the computer. The more specific you are, the more you're going to be in alignment to the result that you're looking for. Which, if you base big picture, so the average gain to loss ratio should be about 0.25 to 0.25 or better. Okay, but depending on the market volatility, you might have a lot of break-even stop-outs. So it just depends. So it's these numbers are changing all the time. 0.25 of 1%. This business about risking 2% on any given trade, that's complete the wrong way. Okay, FX Street saying we have to wrap it up now. So I again apologize. Luckily, we had a shorter presentation today, so I apologize for the technical issues. I'm sure that was a fault on my end somewhere. So thank you all very much. We appreciate your kind attention, and we appreciate that you're willing to do what is required to succeed in trading. Okay. Thank you all very much. Thank you, FX Street, and we appreciate it.